If you're a founder of a listed company and you do not want to let investors dump your shares in a frenzy, Nykaa has a playbook for you. Number one, issue bonus shares, and number two, time the issue just right. How do you do this? Welcome back to Revolution Read On, a daily podcast where we break down one story from the world of business and finance. Click on the subscribe button to never miss an update from us. Here's your story for today. Nykaa's shares have been in a free fall for the last month. That's because the lock in period for its IPO is expiring. So, from November 10th onwards, pre IPO investors can start dumping their shares back into the market. And people are worried that they're going to be dumping their shares in large numbers. Approximately 31.9 crore shares, representing 67% of the company's total equity, will be free for trading now. Something similar happened to Zomato earlier this year, so people's fears are justified. Now, Nykaa obviously does not want this to happen, so it is decreasing its share price itself. Huh? Yes, Nykaa is issuing bonus shares. Each Nykaa shareholder will get 5 bonus shares for each share they own. This means the number of Nykaa shares in the market will increase, but their price will go down. This new price will obviously be more affordable, so many retail investors will be willing to buy them. Now comes the interesting part. The bonus issue, which was earlier taking place on November the 3rd, is now happening on November 11th, the day after the lock in period expires. This is super important for two main reasons. Number one, like we said, a lot of pre IPO investors want to dump their shares. But they need buyers too, right? So if Nykaa makes shares cheaper, more retail investors will be able to buy them, and pre IPO investors will get comfortable exits. Number two, this may just give an incentive to pre IPO investors to stick around. Because if they sell their shares now, they will have to pay short term capital gains tax on them. That's because the bonus shares have just been issued. If they are sold before a year has passed, a 15% tax has to be paid on them. But if investors wait a year, they'll have to pay a 10% tax after an exemption of 1 lakh rupees. So Nykaa has hit two birds with one stone. Ensured proper exit for those who want to leave, but also making sure that not too many shares are dumped at once. But why is Nykaa afraid that investors will dump its shares? Well, the company hasn't been doing all that well. While Nykaa's main platform is doing well, its other verticals are dragging down its performance. For instance, Nykaa Fashion. The platform's monthly average unique users have reached a high of 16 million users, but have remained the same for 5 quarters now. Its net sales have also grown by just 1.1%. Meanwhile, Nykaa Man, its B2B vertical superstore, and other verticals are all seeing losses. Only the beauty and personal care segment, Nykaa's main platform, showed considerable growth. Profit grew 344% YOY, while gross merchandise value, the total order value, grew 45% YOY. However, quarter on quarter growth of gross merchandise value was just 9%. Plus, Nykaa's monthly average unique users also seem to be stagnating now. This could be because a lot of competitors have now emerged in this space, so Nykaa could be facing a tough time ahead. And with its profit margin only 1.09%, it needs to increase its order value to increase profits. Moreover, Nykaa's valuation and its price to earnings ratio seems super high right now, which is probably why pre IPO investors may want an exit now. But will Nykaa's strategy ensure that its share price doesn't fall too much? And for now, it's a wrap on your story for today. Thank you for listening to this episode. We'll be back with more tomorrow.